watching Market Call on BNN Bloomberg. I'm Amber Canmore. Today on the show, we've got David Burrows. He is the president and chief investment strategist at Barometer Capital Management, and he'll be taking your questions on North American large caps. You know what to do. If you're on your lunch break, give us a call, 1-855-326-6266. You can send us an email, marketcall@bnnbloomberg.ca. And you can always send me a DM as well. They are both open on X and Instagram. You can hit me up at Bay Street Amber. David, thanks so much for joining us in studio.
It's great to be here.
So here we go. We got another rate cut from the Bank of Canada. We're expecting one by the Federal Reserve later this month. Can we say we're on a full-on easing cycle now?
Yeah, I think it's very clear. June was the first month where there was no central bank tightening anywhere in the world. We had one tightening in July. That was Japan. And now clearly we're into a liquidity cycle. So that's the most important thing we have to think about for asset valuations is liquidity is the most important thing. And we're into the cycle and it's going to go on for a while. And so it's going to be an interesting time.
Let's talk about how you make changes, or if you make changes in the portfolio. Is now the time to be taking an even greater look at yield? You know, some of the more beaten up real estate, telecom, and we have seen that sector perk up in response.
Yeah, you know, interestingly, rates peaked in October of 2023. And from that time, the bond index in the U.S. and Canada have rallied sort of 10 to 11% total return, coupon plus price. And that's been fine. Having said that, if you were in dividend growers, and more recently higher dividend payers, you know, the returns are like 30%. So, you know, a lot of people, I think, looked at this loosening period and said, well, you better go out and buy bonds, which is fine. But we do think that there are other alternatives. And longer term, we like dividend growth as the strategy. But at this point in the cycle, having some staples and having some utilities and having some pipes in the portfolio, not a bad thing.
Well, I'm glad you brought up those sectors because those are relatively defensive. And let's not forget why we're cutting rates, especially in Canada, because there is a slowdown. You've got gold that's moving up. So is this the time to kind of go cyclical with financials and interest rate exposure, or to your point, to take a look at those more defensive, dare I say, recession-proof areas of the market?
You know, you have to remember that everybody is driven by different decision-making processes. I think the most important thing to take away is that we've moved from a market where in June, only 24% of companies in the S&P were beating the index, and we know a small number had a big portion of that. In the month of August, 63% of companies were ahead of the index. So the market is broadening. It's including groups that had not been participating. Now, from sort of middle of October 22, when the market bottomed, until this summer, financials clearly have led along the way. Industrials have done very well along with tech. But we now have broadened out pharma doing well, REITs doing a little better depending on where you're looking, utilities, pipelines. So we're seeing participation from a lot of different sectors. We're seeing different market caps do better. Sort of mid caps are doing better. Value-oriented sectors are doing better. When you have a broadening in the market, that's healthy. That means people are participating. There's money getting put to work. It's a healthy market when the breadth in the market is broadening.
Well, I think it's interesting. Overnight, we had what looked like maybe it was going to be devastating news for NVIDIA, reports of an investigation by the DOJ. In the after-hours session, it fell. You know, I think it lost the most ever in market cap in history, $280 billion wiped out immediately. And here it is. It's flat now. Does that speak to the resilience of the market?
Yeah, I think habits die hard. You know, there's a lot of people very committed to large cap tech. We are less committed.
Oh,
you know,
did that change recently?
No, I've been quite public with this over the last 3-4 months. Our weight across the firm in tech is less than 10%. So that's about a third weight. It's not because we don't think they're great companies. You know, we owned NVIDIA from $14. but we came out of it a couple of months ago. Because there's other things to do. And realistically, if you looked at the history of semis, when they get really stretched above their 200-week moving average, they have a tendency to correct either in time by going sideways or in price coming back toward the moving average. Both of those would be significant. And so there's just other things to do.
All right, well, let's find out what those other things are. Let's get the calls in and see if we can find some of those opportunities. We've got David Burrows as our guest for the next hour, president of Barometer Capital Management. We're talking North American large caps, so give us a call, 1-855-326-6266. My DMs at Bay Street Amber are open. You're watching Market Call. We've got David Burrows on the show. We're talking North American large caps. Our first question coming from Instagram at Bay Street Amber. John wants to know David Burrows' views on Cameco as an entry point at this time, and it's one of the best performing stocks today. There was a bullish note by National Bank.
Yeah, we like uranium and we like nuclear power longer term. In the near term, on some of the weaker economic data over the last couple of months, some of the basic materials have pulled back more. Uranium probably the most. We owned Cameco. We came out of it at about $63, where it broke the 200-day moving average. Really, that was a technical breakdown for us. I'd love to see the stock get repaired. I think that the future is very bright, and likely over the next month or so, we should see some bottoming in some of these things. But I need to see it happen first.
So it's on your watch list, but not ready to pull the trigger.
Yeah, this is a great company, but we need to have price behavior match up to what we expect, fundamentally. And right now it's not, so we're on the sidelines on this one.
Let's bring in an email, this one coming from Brandon. Thoughts on GFL Environmental for a long-term hold?
Yeah, so we own GFL. We own Waste Connections. In general, environmental services as a group have been performing well, so we've got a good sector backdrop. GFL, recently sort of turned profitable. And so we do think that they have good opportunity. It's a growth stock. Lots of opportunity for additional consolidation. So we own it, but recognize that, you can always get pullbacks, but technically it's hanging in really, really well against the sloppy market. Last couple of days when the market pulled back in August, there was almost no pullback.
It's amazing these roll-up strategies have done so well in a rising interest rate environment.
Yeah, and that's a great point. One of the things that we've spent a lot of time looking at is we think that you need to own companies that generate excess cash flow and don't need a lot of financing in general because the cost of capital is going up. As one friend said to me, and I really like the way he put it, we've had 40 years where the borrower was in control, and today the lender is in control. So we're really focusing on companies that have an excess propensity to generate cash. And we'll talk about some of those names today.
We will. Let's bring in Martin, though, right now. Martin's got a question on the phone lines from Ottawa. Go ahead, Martin, you're on the line. What's your question?
Thanks. My question is on Bank of Nova Scotia. Just where do you see the stock going over the next year or so? It's sort of made a bit of a comeback here. Do you see it kind of going, continuing on this upward trend? Thanks.
Yeah. So let's set the backdrop. As of yesterday morning, 80% of the companies in the financial sector in the S&P 500 made 21-day highs. So that's a lot of stocks making new highs. And this is a sector that has had a broad-based rally. Over 80% are trading above their 200-day moving average. And so we like financials. 25% of our firm's assets are invested in financial services.
Compared to tech, which is 10%. So
right. So this is a big overweight.
Yeah.
Now, we own Commerce and we own Royal. Our tendency is to want to own things that are good getting better, not necessarily broken getting fixed. Having said that, Scotia is going through this navel-gazing process that a new CEO brings to the bank. And so we think that there are changes taking place that are worth watching. it's been a long, dry spell for shareholders, 10 years basically of no money making. But the market is warming up to it. I think it's going to be interesting that the first couple of quarters, generally you get a lot of kitchen sinking, things being thrown out. And so this is one to watch. At this point, though, relative strength versus the S&P or versus the TSX really hasn't picked up much. And we like to see strong relative performance versus the benchmark as one indicator that there's real buying taking place.
I like that. That was so clear. Good getting better. What a nice mantra. Let's bring in John from London, Ontario. Go ahead, John. You're on the line. What's your question?
Thanks, Amber. Hello, David. Speaking of cash flow and increasing dividends, Visa seemed to ignore the pullback on Tuesday. And I discovered on my research two catalysts. The first is Asia Pacific and Visa itself are reporting increased spending in mainland China. Secondly, the AI stock picking program has Visa in its top 7. What do you think of Visa for a 2 to 3 year old hold and adding to it? Thank you.
Look, Visa is a money making machine. They have just such a dominant position and great opportunity. They're going to grow their earnings 12 to 15% a year over the next 3 years. It's not cheap at 29 times earnings. But they just have such a dominant franchise. I don't own it currently, but could.
I asked all my guests this about Visa, but a consumer slowdown, is this the right environment for Visa, stellar though it may be as a company?
Yeah, well, this is one of the things. And when we're looking at where to have exposure in financial services, we have targeted insurance, largely property and casualty, because they've had a great ability to raise the premiums they're charging. We also own the large capital markets banks. Both those types of businesses get lots of leverage out of a strong market cycle, right? They're investment companies. And these fintech companies tend to do better when you're looking at an environment where those companies aren't doing well. They're looking for sort of secular growth. So I think Visa is going to do fine. I don't think it's going to be a world beater in the near term. And ultimately, remember, we're trying to look to 12 months out, not where we are right now. And likely, as we get an easing cycle come along, consumers should start to improve. In general, we have not focused on the consumer in our portfolios in the last while.
Okay, good perspective. We're going to take a quick break, continue the calls, the questions. We're talking North American large caps. We'll be right back. Welcome back to Market Call. We're talking North American large caps with David Burrows. Let's get our next question. This one coming from Instagram. Nickel asking me at Bay Street Amber, is this a good time to buy Amazon?
Look, this is going to be a dominant company for a long time. When we look at the consumer, I mentioned before the break, we have a low weight to the consumer currently. Our two big holdings are Dollarama and Walmart. Costco.
Okay.
So you can see where I'm going with that. We owned Amazon, and we got stopped out of it. We owned it for a long time. But it is in that sort of Mag 7 cohort. We do think that there's some challenge of sort of over-ownership currently that needs to be worked off. So I'd love to see the technical picture improve. As it sits right now, Amazon has traded only better than about 66% of companies in the S&P over the last year. So it's not one of the top relative strength names. And so we'll watch for it. We think it's a great business and a great franchise, just might be better spots right now.
No sustained breakout, right? And it was very late to making a new all-time high. And then when it didn't keep going. It just kind of went back lower.
Right.
Okay. Let's bring in Elliot in Hamilton. Go ahead, Elliot. What's your question?
Good afternoon. Rising from the ashes, does Bombardier qualify under your mantra of a good company getting better? And at what price levels would you consider building a position? Thank you.
Yeah, it's a great question. We've talked about Bombardier recently. Their business jet business, looks great. And certainly financials are getting better. So this is one that's kind of on our list. In industrials, our focus has been more in defense. We have Howmet Holdings, HWM. We own General Dynamics, They've been great performers. And then, excuse me, that we have the environmental services companies in the sector. But it's certainly one to watch, and I think that the secular trend behind business jets are really positive. So we could own it here, we don't.
Okay, let's bring in Nick from Toronto. Go ahead, Nick. You're on the line. What's your question?
Good afternoon. With last week's carnage in Dollar General and today's carnage in Dollar Tree, do you think Dollar General is a good stock to buy at this point? Thank you very much.
Yeah. So one thing you'll never hear me do, Nick, is pick a bottom. We're not smart enough. There's people who are really good at it, but that's not our strength. This stock has been underperforming since January of 2023. So yes, a bad couple of days, but it's been a horrible 2 years. And it's just a company that we stay away from. This is the problem. When a stock looks cheap and then it gets way cheaper, you know, over a couple of days, weak relative strength performers and broken technical stocks can give you some really bad days. And so we prefer to have the fundamentals showing that something is changing for the better. And in general, we're looking for acceleration in the numbers, not just a steady state improvement. And then we're looking for price behavior that would support that view. Two things, technical and fundamental. And the technicals here are just broken. We own Dollarama.
I was going to say, what a stark contrast, the Dollar Trees, the Dollar Generals.
It is amazing. And Dollarama, but great management, great track record. They never disappoint. You know, they under promise and over deliver. Those are the types of companies we like, especially because the leader in a sector has an easier time hiring the best employees. They have a lower cost of capital. It's hard to kill the leader. It's hard to be the laggard and make a turnaround.
Let's bring in Colin in Sarnia. Go ahead, Colin, you're on the line. What's your question?
Well, my question, first I'm going to congratulate BNN for 25 years on the air.
Thank you.
Way to go. My question is about BHP. When I first bought them, the distributions were good and I felt smart. And now I just feel kind of like half dumb. I think their debt's going way up. I'm just wondering what your opinion on BHP is.
Yeah. So the difficulty is that in basic materials, one area that has had a harder time, and partly because of the slowdown in China, is iron ore. Big part of the business for BHP. We do think longer term, we are in the early stages of a long-term bull market in commodity prices, and that the big cash flow generators will pay a lot of dividends along the way. That being said, in the dawn period before an easing cycle, you're going to get some mixed economic data, and that has an impact on these companies. We prefer copper to iron ore, so we own Tech B, and you know, it's been a little frustrating recently, but we can see the runway there. So on BHP, we don't own it. I would probably look at copper if I was going to add something, but I'd like to see a turn. I do like copper longer term, and I like the Tech B in particular because of their new mine. It's really coming up to volume. But in the very near term, the next month or two, you know, we're going to learn a lot. Copper prices have come down to the 200-week moving average. Copper producing index is at the rising 200-week moving average. There should be some support in here. Technically, the copper producers look a lot better.
Okay, we're going to take a quick break. When we come back, we're going to check up on David's past picks. Stick with us. All right, time now for a look at past picks. David, you weren't on last summer, so we got to fix that. We got to get you in the summertime. So we're going to do picks from earlier this year, okay. January 29th. So shorter in nature for our viewers. In terms of timeline, you've only recommended or held them for a couple of months. CNQ is the first one. There was a stock split in there, but the total return is about 12%. A lot of question marks around oil right now. What are you doing with your CNQ?
So we own three big integrateds. We own CNQ, we own Suncor, and we own Imperial Oil. All three are giant cash flow generators. They're all returning cash to their stakeholders. They're buying back shares. And we think that over the next 5 years, the dividends will double, the multiples will double, and the earnings will double. So you can do the math on that.
Why is the multiple going to double?
Because Canadian energy became pretty universally hated. The whole energy sector became pretty universally hated. But we think that those three Canadian companies are unique in their long life assets, and the lack of a necessity to put lots of new capital into the ground. They're very clear about returning capital to shareholders, and we think that because we are at that uncertain period in the cycle heading into easing, yes, there's some economic concerns, but we think over the next 5 years, we're going to be through the next business cycle, and we can't drive down the 400 highway without, gas in the car right now. So we need to continue to produce, and we think that with improved transportation to get product out of Canada, it gives these guys an opportunity.
We already kind of touched on Teck Resources, but let's use this as an opportunity to expand. Total return of 12%, which I guess is pretty good considering copper has come off so much. And you made it pretty clear this is one that you want to stick with. Is it just for the copper exposure? Is there, M&A potential?
Look, there's always M&A potential. I kind of hope that there isn't, because I think it would take away some opportunity. I think when we come back here in 5 years and look at these companies, they're going to be way higher. I mean, if you looked at the last resource cycle from the early 2000s through 2011, Imperial Oil was up 1,600%. Teck was up 1,000%. These, I think we're in a world where inflation is going to be stickier. We are going to get less by way of rate cuts than we think, because I think the economy is actually pretty robust. And if that's the case, these companies have pricing power, right? They can raise price tomorrow when costs go up today. And they have commodities that are relatively tight. We think copper will be tight. If we're going to have AI data centers and we're going to have electric cars, you have to have copper. There's just no way around it.
Won't they be victims of demand, though? Like in that, if this environment that you're talking about, people just won't build.
Yeah, they may not be building as much real estate, but I think that they are for sure going to build data centers, and they are going to for sure be buying electric cars. Norway, I think now is something like 94% of sales electric cars, and they're leading the world. But this is going to continue to come, and Teck has the newest, best producing resource in the world, and by all accounts is living up to expectation and should be sort of at full volumes by the end of this year. So this, I think, is just a great cash flow generator, and it will be a big dividend payer. Japan
was your third pick. And we learned a lot about Japan, particularly in August, and we know the market has been sort of unrelentingly higher. Did Japan's move to tighten rates or signal, kind of signaled and then unsignaled that it was going to tighten rates? How does that all factor into whether you think Japan can go higher? Japan has been trying to create inflation for 30 years. And there has been a long, dry, secular bear market there that ended in 2021. There's a lot of great companies there. The Japanese yen, was certainly the weakening yen people positioned for, and when we had the reversal in the yen, it scared some people. Look, EWJ basically went right back to highs immediately, because it wasn't they were selling Japan, they were selling what they could sell before North American markets opened so they could unwind some of their carry trades. We think a lot differently than Warren Buffett does, but his biggest geographic purchasing is going on in Japan right now. All right, we're going to take a quick break. That's the past picks. Stick with us. We're back to the phone calls. We are talking North American large caps. Phone lines, they're open. So are my DMs at Bay Street Amber. You're watching Market Call. We've got David Burrows on the show. Let's bring in our next question at Bay Street Amber, coming from Cheryl. Can I get David's opinion on Magna?
So in general, Cheryl, we have avoided auto, partly because of what's been happening with rates, partly what's happening with consumer, and we think that there are some risks there. There's a lot of change taking place in that industry. You've got companies in electric cars and out of electric cars. And I think that that's creating a lot of turbulence for the whole ecosystem. And so we've just stayed away. You know, Magna has a tendency to be cheap relative to its peers. But, you know, when the stock falls from 60 to 40 and bounces around, I'm not smart enough to know what the right price is. I would prefer to see a change take place first.
Okay, so you like value, but it sounds like you really guard against what could be value traps.
Yeah, I mean, look, there's a time to own value companies, there's a time to own growth stocks, time to own different sectors. Right now, the auto sector for us is really not investable.
Let's bring in Greg from Windsor, Ontario. Go ahead, Greg, you're on the line. What's your question?
Good afternoon. Thanks for taking my call. David, and oh, by the way, happy 25th to all of you.
Thank you.
David, I really respect your opinion, and I was wondering if I could get your thoughts on Celestica. It's been on a bit of a roller coaster the last couple of days.
Yeah. Well, so Celestica pulled back in the month of July. We rallied to a lower high, and we've pulled back to just above the rising 200-day moving average. To be honest, the price pattern is a lot like big tech, right? When the S&P made a high in early part of July and then pulled back, S&P went back ultimately to match the high. The equally weighted S&P made a new high. That's a great thing, the average stock making a new high. But the NASDAQ 100 basically didn't, and some of the leading stocks like NVIDIA basically didn't. That to me was a tell. So that's why we're not there right now. If you own the stock, I would use the 200-day as a line in the sand, you know, and the lows from the early part of July, which I think are around $40 a share in the NYSE. So I think you just want to be a little cautious here. I wouldn't be adding the stock. I would hold it here. So I think it made a low at around $60. So you break 60, we'd probably have to have a hard discussion.
Okay, let's bring in Hugh from Ottawa. Go ahead, Hugh. You're on the line. What's your question?
I have three stocks for retirees: First Capital, Fortis, and Emera. First Capital is up 26% for the year. Fortis is up 12 or 15, and Emera is up 0.6. And it's got sort of a bad history of increasing in value. I want to sell it, but people are discouraging me from doing that. Is Emera a hold or is it a sell?
Okay, well, let's talk longer term. Near term, a lot of money coming into utilities. And part of that is people looking at rate cuts and expecting bonds to do a little better and things that act like bonds to do a little better. And that's fine. My guess is that we saw generational low in interest rates in 2020, and we are going to see rates ratchet slowly higher for the next 15 or 20 years. So I think inflation is going to be a little stickier, and rates are going to be stickier, which is going to make things that act like bonds harder longer term. So you want to make sure you have dividend growth. And so look at things through that lens. You know, if I were looking at an Emera, I actually probably would rather look at Capital Power, smaller company, better record of dividend growth, and technically a lot better. But again, I would be more leaning toward dividend growth than high dividend, low growth.
Yes,
right? Companies with lower dividends but are growing more rapidly. We're trying to, in our income portfolio, the average company we own has raised their dividend by 15% this year. And these companies are raising their dividend 4 or 5%. So I think a higher dividend growth is going to be more attractive over the next 3-4 years than a high dividend payer that acts like a bond.
Let's bring in Reg from Winnipeg. Go ahead, Reg, you're on the line. What's your question?
Okay, thanks for taking my call. So, David, my question today for you is on Manulife. Now, Manulife doesn't get as much airtime as the bank, so we'll give a little bit of oxygen to Manulife today. But my question is, Manulife Financial it's a global leader in the insurance space, has a 4.5% dividend payout. The banks own a big chunk of Manulife, and when you look at the trading history, it's kind of like a tug of war where the banks are selling the Manulife, buying the Manulife shares. My question is, when you look at the other insurance companies, they're priced a lot higher than Manulife. It's had a good run. It should be easily over $40 a share. Why have the analysts dragged their feet on re-rating Manulife stock? They're way behind on this. If you could kind of clarify, I know that they own and they rate this stock, the banks that own the shares, but it should be well over 40. Your opinion, thanks, Mike.
Yep. So we own Manulife. It's really the one life insurance company that we own. We own it. We like the dividend. You know, dividend growth recently, 10%. That's pretty good.
Finally broke out. You talked about Scotia being this long, sleepy stock.
Yep.
Manulife was right there with it.
Yep, it broke out from $27 and hasn't looked back since. It's up $10 since then. So we think the reasons you own this, you're buying a big investment portfolio, really. And we think that markets are probably 6 months into what is a 3-year cyclical bull market. And so they benefit here. We think over time, rates in general move higher. That's actually good for insurance companies. So I like Manulife, and I think obviously it is an international company. There is some risk, I suppose, in China, but we like it and own it.
Okay, let's squeeze in Dave here. Dave is in Toronto. Go ahead, Dave, you're on the line. What's your question?
Thanks for taking my call. Dave, you've been a top-notch guest on Market Call for years. Appreciate your insights. Thermo Fisher. I've held it for about a year and a half. How much more room does it have to run if I want to hang on for another 2 or 3?
Look, it's funny you mention it. I was talking about Thermo Fisher this morning. We don't own it. We have it in a couple of accounts that actually brought it in with them when they came to visit us. I really like the company. They've done a great job improving their return on equity. They've got pretty stable sales growth. I think estimate for next year is sort of 11-12% earnings growth. And technically the stock is set up well. So don't own it, but probably could own it.
Okay, we're going to take a quick break here. We've got David Burrows at Barometer Capital. We've got a little bit more time for some of your questions. We'll be right back with some of those. All right, we're going to get through all of these questions in this segment. Our first one coming through at Bay Street Amber's Instagram. Leonard wants to know David's opinion on Walgreens Boots Alliance. What a disaster.
You know, this alliance, had all this promise, and they just have not been able to deliver. I look at contrasting what's happened at Walgreens and what's happened at Shoppers here in Canada, and they're two different animals. So, look, I'm not brave enough or smart enough to buy a stock like this and think I'm going to be the one to pick the bottom. We own Loblaws, and part of the reason we own Loblaws is for the Shoppers piece. And so this is just one I would avoid.
Let's bring in Jonathan from Toronto. Go ahead, you're on the line. What's your question, Jonathan?
Well, after Walgreens, what do you think about McKesson? I've been kicking the tires in this one for a while. What do you think?
Yep. So in healthcare in the U.S., we own Lilly, we own Regeneron, and we own McKesson. And we think that McKesson just has a very, very good franchise. Earnings growth this year about 17%, probably about the same next year. You've got dividend growth in the teens, which we think is attractive. We're a little cautious on healthcare because we're in an election cycle, and they're easy targets. But I think it's a very predictable business, and we like the stock.
Bob is in Bowmanville. Go ahead, Bob. You're on the line. What's your question? Oh, Bob, I don't think we can hear you. I don't know which stock you were asking about either, so I'm going to move along to Gary, who's in East Vancouver. Go ahead, Gary, you're on the line. What's your question?
I'm looking forward to hearing about Enbridge. It's something that we talked about. We're a bunch of firefighters out here in Vancouver, and Enbridge is close to the $55 range. And is there a possibility of a split? Somebody had mentioned that last split was around the $60 mark. What's your view on that company? Because it's just, with the interest rates falling, it seems that the stock is rising, and it's getting a little bit more pricier to buy. So just sit back, listen, and I appreciate your feedback. Thank you.
Sure. So we don't own Enbridge currently. People like the dividend. 6.9% dividends attractive. It's going to be a slow grower. So that's the only thing that would hold it back. We have a little bit of TC Energy, and we have our large holding in the pipes is Pembina Pipe, which we think is a beneficiary of what's going on in the oil sands. And ultimately, those midstreamers we think do a little better with a little bit better dividend growth. But for the dividend, you're just not going to get as much dividend growth as you might like.
In Enbridge?
In Enbridge.
Okay. Let's bring in Terry from Sydney, Nova Scotia. Beautiful. Terry, go ahead. You're on the line. What's your question?
Yes, good afternoon. Thank you for taking my call. I'd like to ask your guest, David, what he thinks of Ivanhoe Mines. I've been in it for 6 years now. It's done quite well, and I'm thinking about hanging on to it for another 4 or 5 years. I have a lot of faith in Robert Friedland.
Well, so when we look at some of these commodity producers, they had a first really great leg up in 2022, 21 and 22. We've gone through now a tightening cycle, which certainly held things back. I would be looking for the beginning of the next leg higher, which, I said earlier today, I don't think is a long way away. But these stocks are consolidating, all of them, whether you're looking at Hudbay or whether you're looking at Ivanhoe, they all are consolidating. I don't think that they're technically broken in any way. So I like the stock, and I think that there's another leg coming in front of these things.
Okay. Catherine is on the line from Vancouver. Go ahead, Catherine. You're on the line. What's your question?
David, I must tell you, as my granddaughter is going for a master's degree today, I feel like I'm at a master class with you as the professor. Thank you. I wanted to know your thoughts on Berkshire versus Fairfax Financial.
Right. Listen, they're both great companies. Fairfax, in disclosure, is our biggest holding in the firm.
Wow.
And has been over the last 12 or 18 months.
Why?
Because this is, again, you're buying their investment capacity, and we think we're in a very good cycle. And so, ultimately, beyond what the claims are, you're getting the returns on the investments, and they've got a dynamite investment team. Obviously, Berkshire Hathaway does too. It's a big vehicle, though. You've got to really, make some big decisions to steer the ship. We have a little bit of Berkshire Hathaway. We think they're both great.
Cash.
It's just they're dragging a lot of cash.
Or it's just they're just at a size where.
I wonder if they aren't setting aside capital to be available when there is a transition in leadership. I don't think that they are expecting some horrible haircut in the market. I don't see it myself. So we lean towards Fairfax because it's a little bit more nimble and younger leadership team.
I feel bad for our friend Bob in Bowmanville if he had a tough time with his phone. I do now know what his question was. It was on National Bank. Yep. Any thoughts on National? You mentioned you have Royal and CIBC. Where's National in the portfolio?
We owned National for a long time, and we did get shaken out when they made the purchase of Canadian Western Bank. We thought that the premium was very, very high. But as I've often said, there is absolutely nothing wrong with selling a stock, and if it's the best stock you can find at a higher price, be prepared to buy it back. And so I'm going to guess there's a good chance we'll wind up buying this one back. We think they've done a great job with organic growth. And so ultimately, we're fans.
Okay, that does it for all the questions. We got all 6 in this segment and so many more. Thank you so much for that. Don't go anywhere, though. You won't want to miss David Burrows' top picks coming up next. Welcome to Market Call. Now time for the cherry on top of the show. We've got top picks. The first one is Imperial Oil. Again, you tease this one throughout the show. You have a very select approach to energy, and Imperial makes the cut.
Look, they have rock solid balance sheet to begin with. They have great long life assets. They have operational excellence. This is a company that is going to be a cash flow generating machine. They've bought back a third of the shares in the company over the last 7 or 8 years, and they're going to continue to do that. So we're spreading earnings over a fewer number of shares. 5-year dividend growth rate of 23% a year. So if you can find a dividend that's growing 23% a year and companies that have pricing power, don't worry about inflation, right? That's the big risk. Sometimes the risk is prices go down. Sometimes the risk is inflation eats your money, and that's the bigger risk, I think, over the next 5 or 7 years, maybe not in the immediate term, but we want to own companies that are going to offset inflation.
The second one is gold. We've talked about this. We talked about it a little bit at the beginning, and it's interesting your approach is through owning physical gold.
Yeah, no, we own both, and I've said this every time in the last year that I brought this up because it's an unpopular subject with a lot of people. We are not gold bugs, but there's a time and a place to own different types of assets. Gold had a 10-year run from 2002 to 2011. It went up 360%. In the current world we live in, there is a tremendous amount of government debt. Governments have become the lender of last resort. They can only afford to pay so much. They are going to err on the side of being too easy, and we think that they're on the side of printing money when there's difficulty. Central banks around the world are buying gold right now at the greatest pace they have in a decade. Private investors are not engaged because they've had such a bad experience over time. We think this makes a part of a balanced portfolio currently where you would have less by way of fixed income and have gold as an alternative, as a safety hedge. And gold actually, for the first time in 45 years, is less volatile than a treasury bond. So I think that's a good hedge.
And let's do a little bit of a bonus. So you like the bullion miners too, or?
We do like the miners. We own Agnico Eagle as the best in the bunch. We own Alamos Gold as a growth stock.
Okay.
And these companies are going to generate a lot of cash as well.
So you wouldn't go to like a Newmont?
We think that the middle tier companies are probably the sweet spot.
Okay, your last one is JP Morgan. You mentioned financials and the recent momentum that they've seen. And I mean, who can deny the momentum that JP Morgan has had?
Yeah, I mean, look, this is a great way to think about things. When a sector goes out of favor and sells off, what is the one that sells off the least? What is the one that makes a new high first? In the 2009 crisis, JP Morgan almost wasn't involved. They made a new high in 2013. The sector didn't make a new high till 2021, 8 years later. JP Morgan has the best management. They got the best balance sheet. They've spent by far the most on technology. They are the most efficient. They've raised their dividend twice in the last year. This is sort of the gold standard in the sector globally. And I think it's a centerpiece of any portfolio.
David, it's been an absolute pleasure to have you on. Thank you so much. A masterclass indeed. I appreciate it. That's David Burrows of Barometer joining us for the hour. For those with us in the live programming, we are getting breaking news right now that NDP leader Jagmeet Singh is pulling out of an agreement that essentially helped to keep Justin Trudeau's Liberals in power. We are going to unpack what this means for election prospects, what Jagmeet Singh is going to say about this, all this and more coming up on the other side of the break. Stay tuned. Breaking news coverage next.